The leading index, often referred to as the Leading Economic Index or LEI, is a composite indicator designed to predict future economic activity. It includes a series of economic indicators that typically change before the overall economy does, providing a forecast of future economic conditions. This index is widely used by policymakers, economists, and investors to assess the likely direction of the economy in the coming months. The leading index consists of a set of economic variables that tend to precede changes in the broader economy. These variables, or leading indicators, are chosen because they typically show trends that can help anticipate shifts in economic activity, such as GDP growth, employment, and industrial production. In the United States, the most commonly referenced leading index is the Conference Board's Leading Economic Index, LEI. This index is released monthly and is considered one of the most important tools for forecasting economic conditions. The LEI is made up of 10 key components that tend to lead the overall business cycle. These components are selected because they have historically demonstrated the ability to change direction before the general economy. The 10 components are: average weekly hours, manufacturing, which measures the average number of hours worked by employees in the manufacturing sector. A rise in average hours typically indicates higher demand for goods and a growing economy, while a decline may signal a slowdown. Average weekly initial claims for unemployment insurance measures the number of new claims for unemployment benefits. A decrease in new claims suggests a tightening labor market and improving economy, while an increase signals potential job losses and economic weakness. Manufacturers' new orders, consumer goods and materials tracks the volume of new orders for consumer goods and materials. A rise in new orders indicates future production increases, while a drop could signal a slowdown. The ISM Manufacturing New Orders Index tracks new orders in the manufacturing sector. An increase in the index suggests growth in manufacturing activity, while a decrease indicates a potential slowdown. Stock prices, S&P 500, reflect stock market performance as a significant indicator of economic trends. Rising stock prices typically reflect investor optimism and economic growth, while falling stock prices may indicate concerns about economic performance. The leading credit index tracks credit conditions, including borrowing and lending activity. Tight credit conditions can indicate a slowdown, while looser credit conditions typically signal a healthy economy. The interest rate spread, which is the difference between long-term interest rates and short-term interest rates, shows that a wider spread suggests economic expansion, while an inverted spread can signal an impending recession. Building permits, residential, which measures the number of new building permits issued for residential construction, is an indicator of future construction activity. An increase in permits typically signals growth in the housing market, while a decrease can suggest a slowdown in the real estate sector. Stock prices, NASDAQ Composite, tracks stock prices in technology and growth industries. Like the broader stock market, rising stock prices typically indicate positive expectations about the economy. The Consumer Confidence Index measures the confidence of consumers in the economy. High consumer confidence often correlates with increased spending and a growing economy, while low confidence suggests concerns about future economic conditions. The leading economic index, LEI, is used to predict economic trends, primarily forecasting economic activity over the next 6 to 12 months. When the index rises, it suggests that economic conditions may improve, while a decline in the LEI often signals a potential slowdown or recession. Companies use the LEI to make decisions about expansion, hiring, and investment. A rising LEI suggests favorable conditions for growth, while a falling LEI may prompt companies to adjust their strategies. Policymakers and central banks, such as the Federal Reserve, use the LEI to make decisions about interest rates and fiscal policies. A declining LEI may signal the need for monetary easing to stimulate the economy. Investors and analysts closely monitor the LEI for signs of future market performance. A rising LEI can boost market confidence, while a falling LEI might lead to cautious or bearish sentiment in financial markets. When the LEI is rising or shows a positive growth rate, It suggests that the economy is likely to expand in the near future. A sustained rise in the LEI over several months can be a strong signal that economic conditions will improve. A declining LEI indicates that economic activity may slow down. A significant and prolonged drop in the LEI often precedes recessions, as it reflects weakening conditions in areas such as manufacturing, housing, and employment. If the LEI is flat, it suggests that the economy is neither expanding nor contracting. This can signal a period of economic stability or uncertainty. The LEI helps businesses, policymakers, and investors make proactive decisions about the future. By monitoring changes in the LEI, they can anticipate economic challenges or opportunities before they fully manifest in the broader economy. The LEI acts as an early warning system for potential economic downturns. By tracking a broad range of indicators that reflect future economic performance, it provides valuable insight into whether a recession or economic slowdown might be on the horizon. Unlike single indicators, the LEI provides a comprehensive snapshot of economic conditions. By combining indicators from various sectors of the economy, it offers a more complete picture of potential future trends. The LEI is a critical forecasting tool for the business cycle. Economists use it to anticipate turning points in the economy, such as the onset of a recession or the beginning of an expansionary phase. The leading economic index, LEI, is a valuable tool for predicting the future direction of the economy. By monitoring a set of carefully selected indicators, it offers a glimpse into future economic activity, helping businesses, investors, and policymakers make informed decisions. While it is a useful forecasting tool, it should be used in conjunction with other economic data to provide a well-rounded view of the economy's potential future performance.